Hi, in this video, we will solve example sums on the topic of revaluation of assets and reassessment of liabilities at the time of admission of a partner. We will discuss both method 1 and method 2 in this video. Let's go to the first example. Example 1. A and B are partners in a firm, sharing profits in the ratio of 3:2. They admitted C as a partner and decided to share future profits and losses equally. At the time of admission of a partner C, assets and liabilities of A and B were revalued as follows. A provision for doubtful debts at 10% was made on sundry debtors. Sundry debtors figure in the balance sheet is rupees 50,000. B. Creditors were to be written back by rupees 5,000. C. Building was appreciated by 20%. The book value of building is rupees 2 lakh. D. Unrecorded investments were valued at rupees 15,000. E. A provision of rupees 2,000 was made for outstanding bill for repairs. F. Unrecorded liability towards suppliers was rupees 3,000. Pass the necessary journal entries under the following cases. Case A says, when the revised values of assets and liabilities are to be recorded in the books, and case B says, when the revised values of assets and liabilities are not to be recorded in the books. So now we can find out that for case A, we need to use method 1. And for case B, we need to use the second method 2. We'll first solve the sum under case A. Journal. Date. Particulars. LF number. Debit rupees. And credit rupees. The first journal entry, we will debit revaluation account. Revaluation account needs to be debited whenever there is a decrease in the value of assets, increase in the value of liabilities, or when we have to bring an unrecorded liability into existence. So let's check out those cases. A. Results in decrease in sundry debtors. E. We need to make a provision of rupees 2,000 for outstanding bill for repairs. And F. Unrecorded liability towards suppliers was rupees 3,000. So 2. Provision for doubtful debts. Account 10% on 50,000, which comes to rupees 5,000. 2. Outstanding bill for repairs. Account rupees 2,000. And finally 2. Unrecorded liability towards suppliers. Account rupees 3,000. So totally we need to debit the revaluation account with rupees 10,000, being revaluation account, debited. We'll pass the next journal entry for crediting the revaluation account. B, there's a decrease in the value of creditors. C, there's an increase in the value of asset building. And D, you need to bring an unrecorded asset of investment into existence. Sundry, creditors account debit, ₹5,000. Building account debit, 20% on the book value, which is rupees 2 lakh, comes up to rupees 40,000. And investments account debit, 15,000 rupees. 2. Revaluation account. Total 60,000 rupees. Being revaluation account, credited. We have credited revaluation account with rupees 60,000. The total of the debit is rupees 10,000. So we are left with a gain of rupees 50,000. In the first method, we need to distribute it among A and B in their OPSR. And the OPSR, which is given in the problem, is 3:2. A and B are partners sharing profits in the ratio of 3:2. So we need to divide this 50,000 in their OPSR, which is 3:2. So let's do the transfer of the gain on revaluation to partners' capital accounts. Revaluation account debit to A capital account, to B capital account. Total gain on revaluation 50,000 in 3:2, 30,000 against A's capital and 20,000 against B's capital. Being gain on revaluation transferred to old partners capital account in old profit sharing ratio. So these are the 3 journal entries that we need to pass in the case A. Let's go to case B. Case B says, when the revised values of assets and liabilities are not to be recorded in the books. Case B. So we need to follow method 2. Step 1 under method 2 is to calculate the gain or loss on revaluation. Since we've already completed method 1, we know that the final answer will be a gain on revaluation of rupees 50,000. But anyway, I will be doing it again. The things which we need to add and the things which we need to less. point A results in decrease in sundry debtors. So for A, it is under less 5,000 rupees. For B, it's a decrease in a liability. I'll write it under add. C, there's an increase in the value of building. I'll write it under add. D, unrecorded asset of rupees 15,000. E, we need to make a liability, outstanding bill for repairs, rupees 2,000. And finally F, we need to create an unrecorded liability towards suppliers. So the total of the add comes to rupees 60,000 and the total of the less comes to 10,000. So we have a positive figure, so it's a gain on revaluation, which is rupees 50,000. Step 2 is to calculate gain or sacrifice of each partner. We have old profit sharing ratio between A and B equal to 3:2 and new profit sharing ratio between A, B and C as equal, so it's 1:1:1. So let's do old share minus new share. For A, it's old share 3/5 minus new share 1/3. We get a positive 4 divided by 15 and A sacrifices. For partner B, we have a 2 divided by 5 old share minus 1/3 new share. We have a positive 1 divided by 15. B also sacrifices. For C, it's a gain of 1 divided by 3. So we'll multiply each of these amounts into the gain on reval. So the journal entry solution, date, particulars, LF number, debit rupees and credit rupees. So we need to, it's a gain on revaluation. So we'll debit the gaining partner's capital account, which in this case is C's capital account, debit to the sacrificing partner's capital account, which is to A's capital account and to B's capital account. So on dividing 50,000 by 3, we get 16,667 against partner C. $13,333 against A and $3,333 334 against B's capital account. We got the amount to debit C's capital account by taking 1 by 3, which is C's gain, multiplied by the gain on revaluation, rupees 50,000. We got the amount to be credited to A's capital account as A's sacrifice 4 divided by 15 multiplied by 50,000 gain on reval, and we got the amount to be credited to B's capital account as 1 divided by 15 multiplied by the gain on reval 50,000. So let's go ahead with the narration. Being gain on revaluation of assets and liabilities adjusted amongst partners capital accounts. So these are the steps in method 2. The first step is to calculate the gain or loss on revaluation. The second step is to calculate the gain and sacrifice of the partners. We'll debit the gaining partner and credit the sacrificing partner if there's a gain on revaluation, and do the reverse in case of loss on revaluation. And to get the amounts to be debited or credited, we will take the gain or loss on revaluation and multiply it by the share of gain or share of sacrifice of each of the partners. Let's go to the second example. Example 2. C and D were partners in a firm sharing profits and losses equally. On 31st March 2019, the balance sheet was as follows. We have the balance sheet which is given to us as on 31st March 2019. Additional information. Debtors to the extent of rupees 5,000 were unrecorded. Furniture would be reduced by 10%. Provision for bad and doubtful debts was to be created on sundry debtors and bills receivable at 5%. Value of land and building will be appreciated by 20%. There being a claim against the firm for damages, a liability to the extent of rupees 8,000 will be created for the same. We are asked to prepare the revaluation account. So let's go ahead with preparing the revaluation account. Solution. Revaluation account. Left side debit side and right side credit side. We have particulars, rupee column, particulars, rupee column. The first item, debtors to the extent of rupees 5,000 were unrecorded. So by sundry debtors, there's an increase in the value of debtors. So by sundry debtors, 5,000 rupees. The second one, B, there's a reduction in furniture. So to furniture account, reduction at 10% of the value of furniture, which is 1,10,000, which comes up to 11,000 rupees. To provision for doubtful debts on debtors, we'll begin with we need to calculate 5% provision on, there's an increase in the value of debtors by 5,000. So now the debtors value is 75,000 plus another 5,000, which is 80,000 rupees. And 5% on 80,000 is rupees 4,000. We'll create a provision for doubtful debts on bills receivable also. On bills receivable. So it's 5% on the amount of bills receivable, which is 45,000. Comes to 2,250 rupees. The next point, value of land and building will be appreciated by 20%. So we have by land and building, there's an increase in the value of assets. 20% on the value of land and building, which comes up to 62,000. And finally, there's a claim for damages, claim for damages account. Rupees 8,000. The profit sharing ratio between the two partners C and D, it's equal. So any gain or loss on revaluation will has to be distributed equally between C and D. The total of the credit side, 67,000 rupees. And the total of the debit side is 25,250 rupees. So we have a gain on revaluation. The greater total 67,000 to gain on revaluation transferred to partners capital accounts. On deducting 25,250 from 67,000, we get 41,750 rupees. That's the total gain. Needs to be divided between C and D, and each get half. So each get 20,875 rupees. So this is the way we will prepare the revaluation account while revaluing assets and liabilities in the first method.